Hey folks, welcome back. It's the 10th episode of the MBK Beat, where we talk all things life insurance, executive benefits, and what you can be doing to get more out of your money. This is going to be sort of the finale to the first introductory series, but I wanted to let Mark tell you a little bit about what we're going to be doing, not too much different, but what we're going to be doing in the next series.
Thanks, Jeremy. We thought it would be a good idea as we move forward to post some podcasts that go through some examples of some of the planning strategies we've already talked about conceptually. And I'm kind of excited about doing that. For example, with these bank plans we're going to talk about today, we'll put up some examples and walk people through the numbers so you can actually see how they work. And I'm kind of looking forward to that as we move forward.
Yeah. So go back, make sure to check out a few of the episodes so you can get an idea of what some of these plans are, because we're going to be breaking them down with a little bit more detail, talking some numbers. Really excited about that. But today, what's our topic for today? Because this is the finale.
Yeah, our topic for today are supplemental executive retirement plans, or SERPs, for C-level executives at closely held community banks.
And specifically banks. I know that we've talked previously to some of these plans with credit unions, but it's very different. So that's today's reasoning.
Right. Very different world.
Yeah.
Very different world. In the credit union world, regulations are different, and we have to use a different strategy for banks. But we can end up at the same place with all the goodies that we get for credit unions as well.
And one thing of note, we've talked a lot about split dollar, and as we want to try and break down these things for the viewer that may not know some of these differences, did you want to just define the difference between this sort of split dollar and some of the other split dollar stuff we've talked about in the past?
Well, split dollar plans are cash value life insurance contracts that corporations use to fund, in addition to death benefits, living benefits, retirement benefits, cash benefits for either and or the executive and the corporation. And there are basically two versions. One is something called collateral assignment split dollar that is owned by the executive. That's not what we're going to talk about today. We're going to talk about executive endorsement split dollar, which is owned and purchased by the bank, the corporation, which over time the executive acquires vesting in rights and values in. And we'll talk about that as we move along.
And I know, but for the viewers out there, what's the problem, or what's the problem you see, or why does this work for high-level executives in banks? Specifically, why does this work for them today?
Well, in the commercial banking world, you've obviously got the large and regional banks, and then you've got community banks, and they fall into two groups. You have community banks that are publicly traded, and then you have community banks that are privately owned. And in the community banks that are publicly traded, banks will incentivize and recruit to C-level executives with stock options as a significant benefit. If you're privately owned, obviously you don't have that option of offering up stock options for those executives. So what do you do to recruit and retain and reward executives, C-level executives, in a privately held community bank? Well, an executive endorsement split dollar is a strategy that works, that answers that question and solves that problem.
Yeah, so why don't you walk us through it? Because it all sounds great, but how does it all break down? Because we'll talk a little bit about the results for the executive specifically and then the results for the bank, but why don't you walk the viewer through just the breakdown?
Well, endorsement split dollar is an IRS compliant and bank regulatory friendly benefit that can be used to fund these SERPs, these supplemental executive retirement plans. And it allows the bank to set up a selective arrangement where you pick a group or an individual to cover and to fund a benefit. And and it has a built-in vesting schedule in it. All right. How does it work? Well, the bank will select the group or the individual they want to cover. They will typically establish a funding level or a benefit amount. More often, it's a funding level that they want to fund. We typically fund these arrangements over 10 years, and it ends up providing initially a tax-free life insurance death benefit for the executive's family. The cash values that accrue initially are owned by the bank and represent a cost recovery mechanism to them. After 10 years, all the equity buildup in these contracts accrues to the benefit of the executive, and when he goes to retire, the bank is paid back those dollars they put in the first 10 years, but all the equity buildup accrues to the executive. And the only cost of the executive in the first early years, the death benefit is deemed to be there's an economic benefit to that death benefit under the IRS regulations. It's minor, and he's charged a small reportable income number, and he pays the tax on that. It's minuscule typically. Subsequently, after the 10 years come by, additionally, all that equity buildup, he has to pick up some tax consequences on that buildup. But at retirement, he pays off the bank from the policy. He's accrued all this equity, and he can generate a significant tax-free retirement income stream. I mean, an example we'll put forward, we have an executive 45 years old, and the bank funds $100,000 a year for 10 years. They're going to get back $1 million at retirement. He's going to have enough after the fact to create maybe $150,000 of tax-free income for life, and there's a significant death benefit pre and post-retirement to the executive's family. Pretty good deal.
Yeah. And then...
And he's vested, by the way, after 10 years. And it doesn't require any more funding from the bank.
And then for the bank, they get essentially anything that they put forward for on behalf. So that was that all of the results for the executive, or were there any other results that we wanted to cover for the executive?
No, the executive's going to get initial death benefit, a vesting. He's vested after 10 years. He gets all the equity after 10 years, and at retirement, the bank gets paid back, and he walks away with an unencumbered policy with a big retirement stream attached to it.
If that's someone coming in, or if that's someone that you're recruiting, or someone that you have your eye on, but you don't have some of the stock options or other things in place to recruit them, or also someone that has worked with you for a while and you want to maintain a good relationship and keep them.
Yeah, and typically, your stock options don't vest immediately either. So they may not take 10 years. I'm not as familiar with how stock options work because I don't deal with them. But, there's time that has to pass before you're vested. Well, you're vested here in 10 years, and it's not you have to wait till retirement to get it. I mean, there are other supplemental retirement plans where there is no vesting, or if you're not there at the day you retire, you don't get anything. Zero, nada.
You got to hang on until the end.
Yeah, non-qualified deferred compensation is what it's referred to. Well, there are a lot of those plans out there as well on top of stock options, but there's no vesting, there's no guarantee. Here, you're there 10 years, you got it. And frankly, I've had a number of plans where at some point in time the bank will say, we're not going to ask for that money back. So, which makes it even richer if the guy's done a good job. So these are not complicated plans. They're permissible. They're bank regulatory friendly. They provide a real benefit to the executive and his family. There's a vesting and very favorable tax treatment all the way through and at retirement, and the bank gets their money back. And so it's a benefit, unlike other benefits, typically where it's an expense and they don't get their money back.
And what we talked a little bit about what would be the best time, the sooner the better, but who are we talking about when we look at the age bracket of these executives?
Well, 40 to 50 is the sweet spot here. The example that we're going to put up here, as we move forward, is a age 45 bank executive. But 40 to 50 is the sweet spot. I just was on an appointment this morning and talking to a bank executive. He's 42 years old. The numbers literally rock. And the president, who's 67, said, "Mark, where were you 20 years ago?" But he's done very well. The bank's treated him. They've done other things for him, bonuses and so on. But they want to keep this guy. He's getting calls all the time to go someplace else, and this bank does not want this guy to leave.
Yeah.
And so we're everybody was pretty excited this morning. Now we just got to get the board to sign on, and that's part of what I do.
Yeah, so and then that's a good transition for the results for the bank. Beyond all the results for the executive, what are some of the key results that the bank gets other than obviously the incentive tool?
Well, they've kept a key executive. They're going to get their costs back, and frankly, as the cash accrues initially in the insurance contract, they're booking that as an asset. And they've on a very simple basis, without a lot of government interference or complicated compliance issues, they've taken care of a big problem.
Right.
So it works well for both parties, and the real key is finding the situation where somebody needs something like this to happen, and try to help them go through a process.
And talk a little bit about what that first step would look like for a viewer, because whether they're an executive that might think this is a good idea to bring up and mention because it could be an option for them, or if someone's listening that maybe having someone as a talented piece that's getting these calls, what would be a good first step? Because it seems intimidating a little bit.
Well, the first step is call me.
Mm-hmm.
Okay.
Right.
Let's sit down and talk. Let's establish the ground rules between them and us. Understand the problem. Okay. And then let's get some information and start putting numbers together, which is what I did this morning. We did that with the president and the CFO. By the way, in this case, the CFO called me. He knew what we did, and he called me. And then I met with him, and then I met with the president. Then we all met together and put a package together, run over some numbers, and they've given me some direction on how to present this to the board. And I will help them do that. And if we can get them to sign off, we're on our way.
Awesome. Is there anything else that you wanted to make sure that we covered today?
Good question. I think we've covered it, but the meeting I just left, what really impressed me was the fact that the president, who's getting ready to retire, understands the problem the bank has. The CFO obviously loves the benefit. All right, and he's going to be taking over, and the board, well, they're kind of on the outside looking in, but they've got to approve this. And I told the president, I said, we're not going to drill down to the detail we went into today. We really went down the rabbit hole in some detail so they understand how everything ties together. And we're still dealing with, what's the problem? What's your problem? What's the executive's problem? You can keep in mind, one of the problems executives have, in addition to the recruiting and retention and providing a benefit, is they're not going to get big retirement benefits out of the 401k plan. They're discriminated against, and this helps solve that problem for them. So, here's your problem. It solves the bank's problem. Here's the executive's problem. It solves his problem, and the bank makes out as well because they're going to get their money back. So everybody wins here. And that's what we're going to focus. And it's compliant. It's bank regulatory friendly. that's the message I deliver to the board, and then they make their decision, and then we handhold them to get everything done. And then the devil's always in the details, getting the insurance coverage, getting documents, agreements put in place, making sure you've got your administrative systems set up to handle it. That's what we help them with.
What would be something, let's say hypothetically someone on that board is a skeptic or a pessimist and looking at this plan, what would be something that you could see somebody not wanting to move forward, or maybe a pitfall that would get in the way, or what would be a reason why not to move forward with something like this? Because obviously it sounds all perfect, but what could you see being a pitfall potentially?
Well, the comment came up this morning that 90% of the board, I guess there's 9 members on this board, 90% of the board members are going to buy it. One may not, or there may be some skepticism. The issue is, depending, and especially in community banks, it's also true with credit unions, typically the people on these boards are not making, six-figure income numbers. And, typically we're showing six-figure retirement numbers. So they're not used to these numbers. So, there may be some jealousy there, or they're just living, it's a different paradigm for them. And that's legitimate. That's a legitimate, pushback. And I told the president this morning, I said, John, I said, I get that, and I prepare for that. And that's why you've got to focus on, here's where we are today. All these people are making six-figure incomes now. And this fellow's early 40s. When you project what it's going to look like in 25 years relative to his income in 25 years, just with modest increases, the numbers get huge. Mm-hmm. And in this case, we were actually trying to target a retirement number relative to that future number. We're just trying to get him 60, 70% of what that future number is going to be, which is what all the staff people are going to end up with, but he's not.
Right.
It's a big number. But I said, this is what you got to do if you want to keep this guy. And besides, they're going to get their money back. And this is the way, so this is the problem you've got to solve. And he would like some help with his retirement benefits, because your typical plan, your standard plan, is not going to get him there. So if you want to help him, you want to help the credit union, here's how everybody wins, and the credit union does not lose. That's what I hammer on when I talk to the board. And I may get into some technical questions with them. I give them a lot of backup information, but you've got to. By the way, 90% of the credit union board members, he said, is going to get it. So I just focus on 3 things. I said, your problem, their problem, this is the solution. And we'll make it happen and get it done properly. And that's really how you have to approach this, because, I'm not here to tell people how smart we are, what a great insurance company we're using, or product, or this is the greatest, you got to focus on their situation.
The solution.
Yeah.
Do you find that, hearing that, do you find somewhat of a generational pass down almost economically right now between people like that situation, where there may be someone handing off and moving into the next stage of retirement? Do you find yourself valuable in that sense, where you're sort of bringing everyone to the table?
Well, this is kind of a come to Jesus moment, because you have a huge generational shift in banks and credit unions. Older people, especially in community banks and in credit unions, and they don't like to talk in the same breath, but the reality is the same. An older gentleman done very well. They got a great business model. A younger guy knows how to manage it, and there aren't a lot of guys out there. There's more succession opportunities than there are seats. People, there are more seats to fill than there are people to fill them.
Right.
So there's a lot of job openings, but there aren't that many people that can do the job.
Right.
So these are the kinds of things that attract and keep those people. And if you're serious as a board member about the future of this bank, that's the issue. This is the solution.
I think that's a good place to wrap for today, and I think that's a great topic to come back to in a couple of future episodes. That generational come to Jesus moment. I think that's a good representation of what how much value you can bring to an organization when you've got different generations and some of the trust with some of the board and potential you being having been in the trenches. I feel that that's something that could provide a lot of value to people when making those types of big decisions.
It's not our first rodeo.
That's true. And that's great. Thanks, Mark. Great episode. I look forward to the next one. Viewers, thank you again for listening. Be sure to tell someone. You can listen in the car or check us out on the video. Great suit today, Mark.
Well, it's our summer garb. And by the way, 4th of July is coming up this weekend. Be sure to put your flag out, and God bless America.
All right. Thank you, folks.